Today we're talking about seller financing, owner carry, and how big a deal is it? Now it is a very big deal. In 2020 there was $23.57 billion of first position loans that was created through private lending. So it is a big deal. Now there are rules and regulations that we have to follow as brokers and investors, and those are owner-occupied rules, and they were put out by Dodd-Frank, and it's called the SAFE Act. And the SAFE Act is for owner-occupied real estate. But investment real estate is not subject to the rules and regulations of the SAFE Act. Investment real estate would include rent houses and land and buildings and office buildings and assets that are held for investment, and investment real estate has different rules and regulations to follow. If you're unsure about owner-occupied or investment real estate, I would suggest that you probably talk to an attorney or a CPA or a tax professional and find out about the owner-occupied rules and the rules for investment real estate. Now let's talk about banks for a little bit. Now lenders, all lenders, whether you're a private money lender or you're an institutional bank or FHA or VA or anything like that, you rent money. And rent money, most banks, when you're talking about a bank, they rent the money and then they loan the money out and they collect the spread. This is what it looks like. Lenders pay you a small amount on your deposits, and then the lender loans the money out at a higher rate. Now, private money lender, they're loaning their own money, so they're going to start out with a higher rate, and they want to make a good yield on their money and be protected for the risks that they are taking by loaning out their own money. So here's how it works with lenders or banks. Lenders receive deposits from the depositor, and they pay the depositor's interest on their money, and then they collect that spread and they loan it out at a higher rate. So this is how it would look. The depositor makes a savings account deposit. The bank takes that money and they loan it out at a higher rate, and they get principal and interest or interest only on their money, and then they pay the depositor their portion of the interest. So why don't you or I be the lender? If we have an asset that has equity, and hopefully it would have a lot of equity, and we would want to finance at the market rate. And the market rate may be 3, 4, 5, 6, or 10%. And then the seller of the equity would have income, and that would be annuity income that comes in every month. And it's sometimes called mailbox money. So this was how it would look. The buyer signs a trust deed or a mortgage, and it's held by a trustee. And the buyer also signs a promissory note that's held by the seller, and that promissory note is a promise to pay. And the asset is the collateral to make sure that the buyer pays the payments all the time, or the seller would have the ability to take the property back and hold it or resell it. So why don't you be the seller and owner carry or seller finance? And the new owner gets the income from the rental. They take part of that income and they pay the note holder, and the note holder gets monthly income every month. Sounds pretty good. Now, seller carry and promissory notes, they all pretty well have the same structure. Some deeds of trust or mortgages have more language in it for the protection of the note holder. You can create your own note, your own promissory note against the equity that you have in your property. You would have a trust deed or a mortgage, depending on the state you're in, for your security, and that security would be against the property that you have loaned the money on. So you can create paper, you can buy with paper, and you can add paper to a deal. Now when I'm talking about paper, I mean that's the promissory note, and that promissory note is usually secured by a deed of trust or a mortgage. And so you can create these financial instruments. So you can be the bank. Now, what can you do with paper? About anything that you can do with cash, and you can see on the screen there's several things that you can do with the paper. Paper is a good way to go. To me, it's very safe and very good to owner finance or seller finance your property if it's done correctly. And that would mean a good down payment. That would mean that you have a deed of trust or a mortgage, and that you have monthly payments, and you have vetted the buyer, and the buyer is able to make those payments. Use your equity. You be the bank if that's what you would like. Now, most people don't think about it this way, but these are notes. The note could be the promissory note that you sign. If you look on your dollar bills or your $100 bills, these are a promise to pay, and it's backed by the integrity of the United States government. We are no longer on the gold standard, so the word of the government is what is the security for the note. Also, the checks you write every month to pay your bills, these are notes, and the note is a promise to pay. The security for the note would be the mortgage or the deed of trust, and the note is a promise to pay. And you could have a promise to pay or a promissory note without a security instrument, but it's probably not recommended. But the note is collectible, and the note would be collectible probably against anything that you own if you made a promise to pay. Depends on how the note is worded. So here is an idea. You have a free and clear building. Why not create a promissory note against that building and use that building as collateral? And so how this would work would be that you create a promissory note and deed of trust against that building, and you want to go buy the new building. And what that would do is the new building owner would have a deed of trust against your asset, which means that you would have a lot of equity in that building. So trade the created note plus add cash or other sets to purchase this building. It may be necessary and may not be to add cash and land or other things, but you can do about any deal that you're able to think about. You can add that building as collateral. You could trade that building for the new building and finance the difference. Or you could trade that building for the new building and add land and cash and balance the equities that way and have the new building to be free and clear. What about debt? Now, you can create debt. You can move the debt, assume the debt, and wrap the debt. Those three things, move the debt, assume the debt, and wrap the debt, are not used very much anymore except in special circumstances. Assuming the debt used to be very common, but nowadays they've put due on sale clauses in the deed of trust. And wrapping the debt is the same thing. It's you're wrapping the existing debt with new debt. And then there's interest-only debt, and interest-only debt is usually for short-term loans, 3 to 5 years, 2 years, 1 year, something like that. And there's one other caveat, and that means if you made the debt, you need to pay the debt. And so, yeah, you have to pay the debt. So if you're unsure about debt, or you're unsure about the SAFE Act or the Dodd-Frank Act or investment real estate, then I would consult an attorney or a professional that knows how to do these things, and they can guide you through this process. But debt, for most purposes, can be very, very beneficial if you're dealing in investment real estate or you're buying a house for your personal residence. It can be very beneficial if it's used wisely. But debt can also be an alligator, and it's tied to your ankle. So I would consult an attorney or other professional, a CPA or a tax attorney, to find out what you can do with debt and how to manage that debt and make sure that you can pay that debt. So thanks for watching this video of seller carry or owner financing.